Hey, all you Wall Street winners out there. It's time for the November 14th, 2022 edition of Wall Street Winners. So the market exploded to the upside, and the bull market, which we told you about in the middle of October and called the low in October, is solidly in place. We left a really big gap there. And as you can see here in the S&P, we've broken to new highs. And quite frankly, we're heading at least up to these old highs, and I believe we're going to now be in a bull market, which will take us to new all-time highs. Now, one negativo, the purple predictor, it started to perk up here, but it has yet to surmount these highs. So it shows that the smart money is not behind this rally yet. Now, I would argue that people who subscribe to Wall Street Winners are not smart money, they're the smartest money. And we've been long now for a month, and that's been a thing of beauty. Now, that was the S&P 500. Here's the Dow. The Dow had been leading this market. You can see in the upper right-hand corner, the buying pressure is at a very high level. It can go higher, but it doesn't go higher normally. So this would suggest that the market may consolidate and go sideways, or maybe the Dow stays sideways and the S&P and the NASDAQ play catch up. But I don't think the Dow is going to move much higher than this over the short run. Also, look at this little green line here. This is relative strength index. We're up at this black line. That's the 70 line. And when we get up there, like we did back here, the market doesn't do very well. Now, we got up there, the market sold off. We haven't got to 70 yet, but we're hovering just under it. So combine the RSI situation with the buying pressure situation tells me that the Dow is going to become the laggard over the next couple of weeks. NASDAQ started to play catch up. The gap was bigger. The rally was stronger. We finally broke out above these highs here. No overbought situation with the RSI. Notice the purple predictor is much more bullish compared to the S&P. So I think the NASDAQ is going to now start to outperform the Dow and the S&P 500. It's going to play catch up for a while. Over here, look at this. We're currently neutral on seasonality, but all we have to do is break this high right here on the IWM, and our seasonality indicator will turn bullish. Now, look at this purple predictor. Neutral, neutral, bullish, 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 bullish. So what's happening is that the smart money doesn't like the broad market, but they really like the small caps. So small caps, probably high-tech type companies, are going to be the leaders. Now, what will happen is if we get the IWM to break above this blue line here at about 189-ish, then we're going to start making our positions minimum 50% larger, in many cases 100% larger. So if normally you'd buy 100 shares, we're going to buy 150 to 200. And the reason is because seasonality is a powerful tailwind that actually, because we have this tailwind, the market's going to explode much stronger to the upside, which means our bull positions are going to make more money, and we're going to have a higher winning percentage. And as a result, risk drops dramatically. So by adding 50 to 100% to our positions, we're just putting risk back to normal. So this is super, super critical. And because of the powerful purple predictor, I think we're going to break through this week and turn bullish. Over here, you can see we're supposedly in a kind of a little tepid period. Certainly that's the case with the S&P, but not in IWM or the NASDAQ. Asset allocation, we perked up here. We're starting to suck money out of the bond market and into the stock market, so that's providing a lot of latent buying. Most importantly, though, cash balances are in the trillions. Since retail investors have been bearish for quite some time, that means that as this bull market develops, as we climb this wall of worry, we're going to start sucking money out of the cash market. And that's going to really propel this market to new all-time highs. Another big change, stock market risk indicator. Look at this, pop. So this is we've been running this very low risk profile now for several months. It looks like that's over. I've already told you that the NASDAQ will probably be the outperformer of the three major indices. This is another indication that that's true. They want more risk. So what are they doing? They're buying NASDAQ small cap. We can see it all here. You, as a subscriber to Wall Street Winners, of course, have X-ray vision. You know who's doing what to whom because of our unique indicators that nobody else uses. Wow. Look at this. We're seeing strength, powerful strength over here in Europe. And if I could find a good entry point, I'd get long European shares. Yield curve, kind of, it's an old news now. We've been at negative now for months. We called the recession last year. And we're not yet to the point where we're going to say that the recession is over. Yes, I know the last quarter was positive, but we're going to start slipping back into negative growth again here in the fourth quarter, first quarter. We're going to have a double dip recession, very, very unusual. But this yield curve is telling us the pressure's not off the economy yet, but it hasn't gotten bad enough that it's a buy signal. Bonds got a little pop, as we told you last week, a nice gap up, broke through the previous highs. That's all good. Not ready to buy, but I think this is a mini buy signal right here. Bond key factors, a big change here. So I've been talking to you over the last several months about the dip in the CRB and the dip in the gold market. And since starting here in, let's call it July, they were both going down. That means 6 months after that, we should see, typically 6 months after that, we should start to see interest rates start to go down. So if I go August, September, October, November, December, that means in January, okay? Now look at what just happened though. Gold started to skyrocket. We see a little bit of a mini move up in CRB and gold. Now it's not enough that I'm ready to change my opinion, but so what may be happening is we're going to see a big decline in interest rates starting in December, January, February, and then May-ish, we may start seeing another rally up in interest rates. Now, this is a little bit early, but I'm just kind of giving you an early warning of that. Now, if interest rates are going down, the dollar's going down, and you can see it just fell out of bed there. Fell out of bed, and it's going to keep on going down because interest rates are going to go down. And if interest rates are going to go down, then that means gold's going to go up. So I'm now officially, we broke through these highs, I'm officially now bullish gold. However, the RSI, look at this, we got up to the 70 level. That's always been a tough area for this market. So look for a little bit of a rally and then look for some consolidation in here. Probably for 2 or 3 weeks, something like that. Our indicators, though, all bullish. Now, this one's not super bullish, but that's very bullish. That's very bullish, and that's bullish as well. So time to get on the long gold pattern now. Crude oil. Commodities are generally going sluggishly higher. Gold's obviously starting to perk up a lot, but nonetheless, we want to be getting, I'm not going to really trade crude oil, but our portfolio for fully paid up members know that we're starting to get back into the energy market. So, you know, I think this is going to slowly grind higher, not explode like it did early in the year. Bitcoin fell out of bed, and I'm sitting here kicking myself. I told you for months that a break of these lows here would be a disaster. So I now look for Bitcoin to go down to below $13,000. Why? Because it costs about $13,000 to produce one Bitcoin. And the way any commodity works, including Bitcoin, is that it has to go through periods where you destroy the productive capability. So we got to run the miners out of business. That will reduce the supply of Bitcoin, or reduce the supply of new Bitcoin. And as long as demand stays the same, then Bitcoin will then embark on a new bull market. But this is going to take several months for the miners to believe that you know, it's not worth being in this business anymore. We already have news that they're starting to repurpose their computers. I don't know, to play video games or something. I don't know what they're doing with them. But the point is, this break of all these lows down here at about 18,000 and small change, that was a death knell for the near term for Bitcoin. Freebies, you know what to do. I want to tell you about a concept that we call extreme profits. I'll tell you what it's generically called in a second, but this is the most powerful risk management tool ever invented. Now, normally I use a technique, and what I teach in most of my courses is a technique called fixed fractional. And I teach that technique for a very simple reason. It's the best balance between a risk and reward, the best balance. But extreme profits, this technique is not about balance. It's about extreme profits. So it's kind of insane, but it does lead, it can, if you do it right, you have to do it right. So there is a caveat there. You have to do it right, and then it becomes the most profitable system ever. Now, this is based on research by John Kelly, who was a Bell Labs scientist, and it was perfected by my friend Ed Thorpe, who was the guy who really popularized card counting in blackjack. And it's called the Kelly formula. You can Google it and you can learn quite a bit about it online. And what the Kelly formula does, though, is it's not designed for this balance between risk and reward. It's designed to maximize profitability. Maximize profitability. So it turns risk management from a defensive weapon into an offensive weapon that you can wield to maximize profitability. Well, it's, nothing is for free. So the bad news with this technique is that there's much higher equity volatility. If you did it the way Kelly and Thorpe used it, you could see your account drop 50% in one day. Now, that's not the way I use it. I've completely modified it so that it's far more relaxed. Still higher equity volatility than I normally have and what I normally teach, but much less than the way it's taught by John Kelly, Ed Thorpe, etc. The good news, if done correctly, it can lead to dramatically higher profits. I said a second ago that you could lose 50% in one day. Yeah, but you could also double your account in a day as well. So, as you can see, it's dramatic in both directions, but do it correctly. Now, the Kelly formula was actually invented for as a formula, John Kelly, to how to get more information to go through a copper wire. He worked for Bell Labs, and so they were trying to figure out how to get more information to go through a copper wire. But then guys like Ed Thorpe and other mathematicians came along and realized that it could be used for gambling and it could be used for investing. And Ed Thorpe built a tremendous career as an investor. I wouldn't even say he was all that good of an investor, but he used the Kelly formula better than anybody I've ever seen. So that's what it's all about. Now, hang on. See, I'm going too fast. I'm too excited. So how can you get this? We've put together a course on extreme profits. I used many years ago. I did a course quite often. It was a $5,000 course, and we did it on futures and Forex, and it was incredible. I mean, it was just an incredible course that cost $5,000. Well, what we've done is we've now adapted this for stock traders. This is amazing. Nobody's ever taught anything like this ever. Now, in order to get this, you have to join the Wealth Builder Insider Membership Program. And that's a modestly priced monthly membership program. I'll show you the URL in just a second here, and you can click on it. But you get this course, which we're posting pieces of it every day now, on the website. And you get that, but then you get the most extensive education on stock and option trading in the world. This membership site Well, I'll be frank with you. The problem with it is that there's too much. You get too much. So we even had to add a section on how to actually attack the website, because it's going to teach you asset allocation, stock selection, swing trading, position trading, multiple techniques for a stock selection, ETF trading, everything. It's really, quite frankly, a bit overwhelming. So the very first section, which we call the hub, tells you how to attack it in a logical manner, depending on what you're most interested in. And of course, we also have options trading on there as well. And that's all for one low monthly price. This is like getting 10 PhDs for a peanut. So where can you get this? Well, it's pretty simple. You just go to wealthbuilderinsider.com. wealthbuilderinsider.com. You don't need the capitals, but I just made it capital so you can read it easier. But go there, check it out. Remember that what's not on this website here is we've just added our Extreme Profits for Stocks course inside the Wealth Builder Insider. All right, everybody, go there now. I'll see you inside.